Thank you, Renee, and thank you to all of you for joining us today. As we get started, I want to say that we certainly welcome any comments any of you may have on today's presentation, and we are also interested in hearing from you about any suggestions or specific topics that you would like us to consider for future webcasts. For your reference, our contact information is provided at the end of this presentation. It is worth noting that the source of all the data presented today is from the AFS Pricing Dashboard. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. In addition, the AFS Pricing Dashboard is also used to prepare our monthly Pricing Trends newsletter. If you are interested in receiving our newsletter, you can reach out to me and we will be glad to add you to our mailing list. And if anyone is interested in learning more about our pricing dashboard, again, you can reach out to us. Our contact information is provided at the end of this presentation. Starting at the top of slide 4, we provide some economic statistics to help put the second quarter results into perspective, as well as the year-to-date results for 2018. First, the pace of annualized real GDP growth accelerated in 2Q18 to an annualized rate of 4.1% in the latest quarter's release. This almost doubled last quarter's rate and is the highest rate seen in years. Next, we see oil prices at $74 at the end of the second quarter, which was an increase of $28 from a year ago. However, prices have dropped recently. Last week, the price was $68, but still $22 higher than last year. And as we will see throughout this webcast, this rebound in oil prices has generated a lot of activity in the mining, oil, and gas sector. Also, as shown at the bottom of this slide, the 10-year Treasury at the end of June was 2.91%, which is up 72 basis points year over year. Each of these statistics contributes to the broader U.S. economic outlook, and together with the continued uncertainty surrounding the trade talks that are taking place, the real impact of the tax cuts, and the upcoming elections in the fall, all presents extraordinary challenges to banks trying to manage their bottom line. On the next slide, we look at rates. This chart is provided to give some insight into the second quarter market rates versus the actual bank pricing. The numbers on the right side of the chart show the year-over-year change, with the arrows indicating if rates are up or down. Again, we see the 10-year Treasury, the solid blue line, is up 72 basis points year over year. Looking at a shorter time horizon, we can see that the 10-year rate rose 51 basis points since the end of last year. We also see the LIBOR rate, shown as the yellow dashed line, at the end of June was 3.92%, which, like the 10-year rate, is also up 72 basis points year over year. And the benchmark one-month LIBOR rate, the red line on this chart, is up 87 basis points year over year. We will look into the bank pricing versus market rates in more detail later in this webcast. As we do in each of our webcasts, we will look at commercial lending with a focus on balance growth, line utilization, new and renewed volume, and pricing for spreads and fees. For our special topic today, Jeremy Charlson will present a markets to watch analysis focusing on key pricing and credit risk trends across the leading regional markets. So with all this to cover today, let's move to slide 7, where we provide a quick high-level overview of the commercial lending market. Starting at the top left, a quarterly trend of total balance growth is presented. we can see the pace of balance growth in the second quarter accelerated from the first quarter, up 1.2%. We commented in our last webcast that the 1Q rate was better than 1Q17's growth rate, but a far cry from the first quarter growth rate seen in 2014, 15, and 16. The same can be said for 2Q18. That is, the second quarter growth rate is better than the second quarter growth rate of 2017, but not as good as the previous 5 years. The top right chart shows that there is a year-over-year increase in June for both new and renewed loans. The chart on the bottom left shows a trend of the weighted average LIBOR equivalent spreads for new loans and renewals. Although both new and renewed loan volume was up year over year, the related LIBOR equivalent spreads were down when compared to June 2017. New loans decreased 25 basis points and renewals were down 18 basis points. And finally, on the bottom right chart, we see that total annualized fees as of June were very similar to last year's fee levels, with modest increases seen across the major fee categories. With this quick overview as a backdrop, we will now examine how these pricing dynamics are playing out differently across the various lending segments. But before we dive into the numbers, in our last webcast, we left wondering once again if the pro-business policies coming out of Washington would lead to a surge in corporate borrowing. On the one hand, we noted that several bankers believed that loan demand would pick up, but others talked about the new tax laws providing a cash windfall to companies and therefore reducing their near-term need for loans. We now know that the second quarter saw a pickup in business borrowing, which reversed a prolonged slump in business loan growth that has existed over the last couple of years. Although it's not clear why demand has picked up, some are speculating that companies are laying the groundwork to expand, while others are still on the sidelines, concerned about the trade talks taking place and therefore being more cautious. There is also concern that some of the recent growth was created by banks loosening terms and easing credit standards, which could lead to problems down the road. So what is next? Despite the fact that the second quarter saw some momentum, is the business loan drought really over for banks? In our next webcast, we will look into how this all plays out during the third quarter. We are already starting to process July's results, so stay tuned. On the next slide, we take a closer look at the types of loans driving the trend in overall balance growth. The top chart on this slide compares quarter-over-quarter growth rates between bilateral loans, the blue line, and participations, the orange line. For those of you that were on our last webcast or receive our monthly newsletter, you may recall that at the end of the first quarter, bilateral balance growth quarter-over-quarter was down 0.2%, which was the first time since 1Q13 that the 1Q quarter-over-quarter growth rate was negative, while participations finished with a positive rate of 1.88%. At the end of the second quarter, we see that bilateral loans reversed the course that we saw last quarter and finished with a positive quarter-over-quarter growth rate of 1.2%. Participation balances also finished in positive territory this quarter, up 1.1%. Looking at the year-to-date growth rates, we see that both bilateral loans and participations are up as of June. Bilateral loans have increased 1%, and participations are up 3% year-to-date. When we segment the growth by various loan sizes, the bottom left chart shows that bilateral balances were lower across the loan size segments, less than $5 million in size, while the larger loan size segments and CRE have increased during the first half of the year. For participations, the chart on the right presents a different story. Here, balances have increased this year across every loan size segment and CRE. The CRE segment is illustrated in greater detail on slide 10. Here we see that the balance growth for CRE bilateral loans, which is depicted by the blue time series in the top chart, was up 2.4%, which is the highest second quarter growth rate we have seen for the past 7 years, while CRE participation balances were up just 0.5% in 2Q18. From a year-to-date standpoint, the growth rate for bilateral loans surpassed the growth rate for participations, with bilateral loans increasing 2.5% during the year, while participation balances rose 1.1%. Moving to the bottom left chart, we segment the CRE activity for bilateral loans by size and see that only the smallest loan size segment, less than $1 million in size, reported a negative year-to-date growth rate, while the greater than $25 million loan size segment is up more than 7% year-to-date. The chart on the right shows the year-to-date growth for CRE participations. Here we can see that significant growth took place in the two smallest size segments, up 11% and almost 4% respectively. Worth noting here is the loans greater than $25 million showed a decline of approximately 0.5% through March and has rebounded during the second quarter, posting a growth rate of a little more than 2%. Moving on to slide 11, we look at balance growth trends a little differently. Here, the balance growth is measured using the year-over-year growth rates for each month. For example, we computed the growth rate using March 2018 versus March 2017, and February 18 versus February 17, etc. We then plotted the resulting rates for each month. So, in addition to the month-over-month changes we saw in the preceding slide, this chart provides a way to quickly see how balances are trending on an annual basis. This chart also allows us to better account for seasonal activity. Please note, these two charts are plotted using two different scales on the y-axis. The chart on the left presents the aggregate loan trend, and the chart on the right breaks out bilateral loans and participations. As you can see, the growth trend for total loans was trending upward until May 2015, and then experienced a significant decline until July 2017. In recent months, the trend has held steady and most recently trended up. The year-over-year growth rate for June is 2.37%, which surpassed the 1.5% rate we saw for March. Moving to the chart on the right, we can see that participations were responsible for this steep decline, even going into negative territory from March 2017 through March 2018, while bilateral loan growth remained fairly consistent. June's year-over-year rate for bilateral loans is 2.6%, and with participations trending up over the most recent months, the year-over-year rate for participations is 1.7%. Next, we leverage our pricing dashboard's drill-down capabilities to pinpoint specific geographic and industry drivers of balance growth. We start with a look at the state profile. You can think of this as the regional winners and losers. The top 5 states and bottom 5 states are reported. It is important to mention the geographic data presented in this webcast is based on the location of the borrower, not necessarily the location of the bank booking the loan. The chart at the top of slide 12 presents a state view for all loan types and reports the year-to-date balance growth through June 2018. These charts are based on the change in the outstanding dollars to determine the top 5 and bottom 5 states, and then presented ranked by the percentage change. New York reported the largest growth in total balances during the first 6 months of 2018, up 3.9%. Higher balances in the finance and insurance subsectors for securities and commodity contracts, and funds, trusts, and other financial vehicles contributed to this growth. We also see Texas and Massachusetts up more than 3% year to date. The finance and insurance sector was also responsible for the higher balances in Massachusetts, while Texas showed growth in the information telecommunications subsector, as well as in the mining, oil, and gas sector, more specifically in the oil and gas extraction subsector. A breakout for bilateral loans is shown in the bottom left chart. Minnesota and New York had balances increase well above the national average. The total balance growth we just saw for New York was due to increases of 4.3% in bilateral loans and 2.6% in participation loan balances. The only other top 5 state to report loan growth for both bilateral loans and participations was Florida, with participations outpacing bilateral loans through June. At the other end of the spectrum, lower year-to-date bilateral balances were reported in Maryland, and year-to-date participation balances dropped significantly in New Jersey and Connecticut. Using the AFS Pricing Dashboard, you can also examine trends within states. Our pricing dashboard is configured to drill down beyond the state level and view trends for specific core-based statistical areas, or CBSAs. For example, we just saw Florida in the top 5 states for both bilateral and participation loan growth. On slide 13, we can see that the year-to-date growth rate for bilateral loans in Florida exceeded the national average of 1%. And Miami, Orlando, and Tampa all contributed to that higher than average year-to-date growth rate for Florida. However, the year-to-date growth experienced in the other CBSAs, Jacksonville and Northport, Sarasota, were lower than the aggregate Florida state rate of 1.22% and actually have lost ground during 2018. This geographic precision allows us to distinguish the winners and losers very quickly and is the type of data you can leverage to be very competitive in your own markets. We will see more on the activity within Florida later in the special topic section of today's webcast. On the next 2 slides, we adjust our lens and look at not only the top 5 and bottom 5 states, but the entire country. On slide 14, the colors on the map indicate the level of dollar balance growth experienced by a particular state, with dark green indicating the highest level of growth and red representing a decline. So you can think of this view as a balance growth heat map for the balance growth across the country. The map on this slide focuses on bilateral loans, and we can see that balances were down across several states at the end of June. However, states such as New York, California, and North Carolina experienced significant growth in bilateral balances, as indicated by the green shading. New York and California saw significant gains in the real estate and finance and insurance sectors during the first 6 months of 2018. And in North Carolina, the manufacturing sector, focusing on wood products and non-metallic mineral products, have driven up bilateral balances this year. The map presented on slide 15 changes our focus to the balance growth for participations. With higher balances in the oil and gas extraction subsector, Texas is the top-ranked state for participation loan growth this year. In Arizona, we saw higher balances in the manufacturing of semiconductors and related devices subsector, and the finance and insurance sector drove up participation balances higher in New York. Even though balances are up across most states, we can see that participation balances decreased in several states, especially across the middle of the country, from Minnesota straight down to Louisiana. As we move to slide 16, we continue our focus on balance growth and highlight the best and worst performing industries. The mining, oil, and gas sector is ranked highest for total balance growth for the first 6 months of the year, with the largest growth in Houston and Dallas, as well as Denver and Oklahoma City. As shown by the bottom 2 charts, wholesale trade ranks among one of the top 5 fastest growing industries for both bilateral loans and participations, up 4.6% for bilateral loans and up 7.7% for participations. Finance and insurance is another industry with significant growth this year in both bilateral loans and participations. For bilateral loan growth, finance and insurance is the top industry, especially in cities like San Francisco, New York, and Houston. Honing in on participation growth, we see that in addition to mining, oil, and gas, the wholesale trade sector is also a top performer in the participation space, with growth seen in the merchant wholesaler durable goods subsector in Cleveland and Atlanta. On the opposite end of the spectrum, the utility sector and the professional, scientific, and technical sector have experienced the largest balance declines this year. A few slides ago, we saw the granularity that the AFS Pricing Dashboard provides users when looking at trends across the country, with insight down to the CBSA level. Our pricing dashboard also lets you examine trends within industries. Industry trends can be analyzed all the way down to a 6-digit NAICS code. On slide 17, we see that within manufacturing of wood and chemical products, chemical manufacturing had a positive impact on loan growth. Drilling further down to the 6-digit NAICS level, we see that 3 subsectors were responsible for the growth seen this year: miscellaneous chemical product and preparation, pharmaceutical preparation, and plastics, material, and resin manufacturing. Having this granularity is something for you to consider when you need very detailed data to support your own pricing decisions. So far, we have focused solely on geographic views of the data, or views based only on industry sectors. With the AFS Pricing Dashboard, users are not restricted to view one dimension at a time. Rather, you can examine cross-sections of regional and industry segments to better understand what is driving balance growth across your own geographic footprint. On slide 18, we highlight each state's top C&I industry for bilateral balance growth. The shading of this map corresponds to the various industry segments as detailed by the legend on the bottom left. For example, for the first half of 2018, major business centers in several states across the middle of the country, such as Minnesota, Iowa, Illinois, and Missouri, as well as 10 other states sprinkled across the country, reported their largest C&I bilateral balance increase in the retail and wholesale trade sector, which is shown here with the dark green shading. To help you understand how the industry groupings presented here are defined, the next slide, slide 19, provides a breakdown of the industry groupings. We combine similar 2-digit NAICS sectors to create broader industry groups. This helps to present a more concise picture of the industry growth trends across the country. For example, we combine the 3 NAICS manufacturing categories into an aggregate manufacturing segment. On the next slide, we'll leverage the same mapping to present industry growth across the states for participations. On slide 20, we highlight each state's top C&I industry for participation balance growth. Once again, we focused on the retail and wholesale trade sector with the dark green shading, and we can see that most of the states in the eastern Midwest region of the country, Wisconsin, Michigan, Ohio, and Kentucky, report this segment with the largest participation growth for the first half of 2018. As the last few slides have demonstrated, there are clearly a handful of geographic markets that have generated balance growth well above the national average. On slide 21, we present a more concise picture of this dynamic. Here, we identify and aggregate the top 10 CBSAs based on their contribution to total U.S. real GDP. The hypothesis is a region's level of economic activity is proportional to its potential for future loan growth. The top 10 CBSAs are illustrated in aggregate by the dark blue bars, whereas the lighter shaded bars represent all other geographic markets. Since March 2016, the pace of total balance growth for the top 10 CBSAs has accelerated during every quarter, far outpacing the growth rate for all other geographic regions. You can see on the far right that while total loan balances for the top 10 CBSAs continued to grow in 2018, especially during the second quarter, the remaining markets had been treading water, hovering around a 2.5% to 3% growth rate. Even though the other regions saw balances spike up in 2Q to 3.4%, it is a far cry from the 11.7% second quarter growth rate for the top 10 CBSAs. The implication here is that while some are saying business borrowing is picking up, the top 10 CBSAs have continued to experience significant increases in total loan balances. And the AFS Pricing Dashboard has the data to help you find where opportunities exist in today's improving markets. On the next slide, we look at another component of balance growth, line utilization. The chart at the top of this slide shows the overall line utilization rate at the end of June was 38.4%, which is up 0.2% since the end of the first quarter. In fact, all deal size ranges went higher during 2Q, except the smallest range, lines less than $1 million in size. We continue to see significant variation in utilization rates both within and across state and industry segments. As shown by the bottom left chart, June's line utilization for Utah was 57%, which was more than twice as high as the 28% utilization in Nevada and Missouri. Looking across the industries, we saw a higher utilization rate for agriculture in June when compared to March, up 3% to 48.8%, which is trending like previous June utilization rates for the agriculture sector. Although the three manufacturing sectors are not in the top 5 this month, we did notice that 2 of the 3 manufacturing sectors also had higher utilization rates in June than they did at the end of the first quarter. We will continue to monitor these trends and their impact on the market's overall loan growth. In addition to examining trends in total balances, the AFS Pricing Dashboard enables users to analyze trends for new and renewed loans. At this level, we can better understand the impact of the most recent lending activity. On slide 23, we begin with a look at new and renewed bilateral loans. Starting on the left, we can see that June's new loan volume is lower than last June, and renewal volume is slightly lower than last June. When compared to the prior month, new loan volume and renewal volume are both higher, with balances in the finance and insurance sector growing the most. Higher new loan balances were also seen in the manufacturing sector focused on wood products and chemical manufacturing. Higher renewal balances in the wholesale trade sector, the public administration sector, and the healthcare sector contributed to the increase we saw in June. Moving to the chart on the right, we focus on the pricing of the most recent lending activity. The LIBOR equivalent spreads as of June for both new and renewed loans are lower than June of last year. When compared to the previous month, the weighted average LIBOR equivalent spreads for new loans went down 3 basis points to 198 basis points. For renewals, the average spread fell to 213 basis points, down 2 basis points from the previous month. For your reference, the 10-year Treasury is also provided. As mentioned earlier, the 10-year Treasury for June was 291 basis points, which is 7 basis points lower than last month's rate. The drivers of volume and pricing dynamics are also presented on slide 24. The charts on the left provide the state and industry distributions of new and renewed bilateral volume for the most recent 6-month period, or in this case, the first quarter and second quarter of 2018. On the right side of this slide, we present the weighted average LIBOR equivalent spreads for the same list of state and industry segments. This view allows you to quickly see the correlation between loan volume and spread pricing. Focusing on the top of this slide, we can see that California, New York, and Texas captured the highest volume during this period. From a pricing perspective, loans in the mining, oil, and gas sector and the healthcare sector drove up the average spread for Texas to 247 basis points, while California was closer to the national average of 213 basis points, with loans in the wholesale trade sector carrying an average spread of 216 basis points and loans in the manufacturing sector with an average of 206 basis points. Moving to the bottom left chart, we can see that finance and insurance outpaced the other industries during this time period. While balances for this sector grew at a high rate, spread pricing of 202 basis points was below the all-industry average of 213, as shown on the bottom right chart. We also see mining, oil, and gas with the highest average spread at 314 basis points, and we saw high spreads across most subsectors within this industry, especially the oil and gas extraction subsector. Another industry that reported a high spread is professional, scientific, and technical services at 253 basis points. One subsector responsible for this higher than average spread is the architectural, engineering, and related services, which had a spread of 261 basis points. Next, we will look at the volume and pricing trends for participations. On slide 25, the chart on the left shows that new and renewed participation volume was up in June from both the prior month and the same period a year ago. Looking at the chart on the right, a negative correlation is seen for new loans and renewals when compared to June of last year. Although loan volumes are up, the weighted average LIBOR equivalent spread for new loans is down 37 basis points, and the average spread for renewals fell 25 basis points. When compared to the previous month, a negative correlation is seen once again. With loan volumes up, the weighted average LIBOR equivalent spread for new loans is down 17 basis points, while the average spread for renewals fell 9 basis points. Moving to slide 26, the chart on the top left shows that over the most recent 6-month period, Texas, California, and New York captured the highest new and renewed participation volume. The top right chart shows the pricing characteristics of these states, and we can see that Texas posted an above-average LIBOR equivalent spread of 252 basis points, which can be attributed to the loans in the mining, oil, and gas sector. In fact, the average spread in the mining, oil, and gas sector for the state of Texas is 294 basis points. For the second largest state, California, new and renewed loans booked in the finance and insurance sector and the sector covering the manufacturing of machinery and electrical equipment had spreads of 160 basis points and 170 basis points respectively, which accounted for California's below-average spread of 184 basis points. On the bottom left chart, we see manufacturing of machinery and electrical equipment ranked as the largest sector for new and renewed participation volume. While volume is high in this sector, the average spread of 167 basis points was 30 basis points beneath the all-industry average, as shown on the bottom right chart. The computer and electronic product manufacturing subsector, with a spread of 137 basis points, contributed to this lower than average spread. Next, we look at the final layer of our market review. Slide 27 focuses on commercial loan fee performance. Fee revenue is a vital component of overall bank profitability, and the chart at the top of the slide shows that total annualized fees as of June were slightly better than levels reported in the same period a year ago. As we saw with loan volume and spread pricing, the AFS Pricing Dashboard enables users to examine regional and industry drivers of fee performance. Mirroring the overall fee trend, the chart on the bottom left shows that for all regions except the West, upfront fee performance was up slightly from the same period a year ago. From an industry perspective, the bottom right chart shows the industries with the highest fee level were mining and utilities. Looking at fees paid during the first 6 months, we have seen numerous six-figure fee amounts booked to these two industries. As we've seen throughout this presentation, the pricing dashboard can be used to shed light on loan growth trends for specific geographic and industry segments. Many of our clients are using the pricing dashboard in this precise manner in order to gain strategic intelligence into both new and existing markets. As a template for this type of analysis, on slide 28, we organize the states into 7 broad geographic regions. Let's say, for example, that your bank was thinking of increasing its market share in the eastern Midwest part of the country. The top right map highlights the eastern Midwest. Using the pricing dashboard, we can see that wholesale trade is one of the top industries for bilateral loan growth in this region. The leading industries for balance growth across the other areas of the country are shown on the bottom of this slide and on the next slide. This is a quick way to see which industries rank among the best performers across the country. It's also worth mentioning that the AFS Pricing Dashboard allows users to analyze all the major metropolitan areas in the country. To support specific regional pricing strategies, we have helped users define their own custom regional footprints in an effort to pinpoint specific loan growth opportunities. Please let us know if we can help you with this type of analysis. Again, our contact information is provided at the end of the presentation. Now for our special topic section of today's webcast, Jeremy Charlson will build on what we saw earlier and present a markets to watch analysis, which will focus on key pricing and credit risk trends across some of the leading regional markets. With that, I'll turn it over to Jeremy.
All right, thank you, Don. With commercial credit quality being so good for so long, it has many bankers somewhat anxious and looking for signs of the inevitable changing in the cycle. There was that Wall Street Journal article that Don had flashed up a little while ago that pointed to perhaps an easing in lending standards. But the truth of the matter is, the market rarely turns on a dime or turns as a whole. Rather, risk tends to appear first in a particular asset class or in a particular industry like mining or in some part of the country. And for that reason, it sometimes can be hard to detect if you don't know what you're looking for. So to that end, this quarter we're unveiling a new analysis that we're calling Markets to Watch. We've done similar analyses in prior webcasts and newsletters around industries that are showing favorable or unfavorable trends in spreads and risk. This analysis builds on requests from several of our listeners to focus our attention on some key geographical markets that may be showing signs of overheating by looking at a combination of recent loan volume, spreads, and credit risk. In this analysis, we pinpoint and analyze 2 categories of geographic markets. The first is what we might call a high opportunity market. So that's one where we're seeing loan growth increasing, spread pricing is up, and credit risk is down, so the growth is supported by strong risk and return fundamentals. The second is what we're calling a watch list market, and that's one where while loan growth is trending upwards, spread pricing is down and credit risk is up, so the risk-return margin is narrowing. So we're going to spotlight those two types of markets, and you'll see there's quite a bit of diversity across the country. Now, one takeaway from Don's section of the webcast was that balance growth was very concentrated from a regional perspective. For example, we saw that much of the loan growth in recent years was driven by the top 10 CBSAs in terms of GDP. So building on this analysis, we highlight many of the largest metropolitan areas in the country, both in terms of loan balances and in terms of GDP. That's what's shown here on this map. The arrows for each one of these metropolitan areas indicates the change in outstandings, spread pricing, and credit risk from 2Q17 to 2Q18, so a one-year horizon. Regions with red markers form our watch list. So these are regions that reported an increase in loan balances, but on average, pricing has decreased and credit risk has increased or deteriorated. Noteworthy red markets are Los Angeles on the West Coast and then on the East Coast, New York. And I think that's notable because these two regions regularly lead both bilateral loan and participation balance growth. Metros with green markers, they display the opposite profile. So a green market would be one where balance growth is trending upwards and is complemented by favorable risk and return trends. So of the regions shown here, if you look on the East Coast, Charlotte appears as a high opportunity market. We're seeing balances go up, pricing increasing, and risk trending downwards. Metros with yellow markers, they have a mix of both favorable and unfavorable risk-return characteristics. So take Miami, for example, in Florida. The year-over-year decline in pricing was commensurate with a decline or an improvement in credit risk. So we might call these types of geographic regions neutral in terms of their risk-return profile. The detail behind the map is shown over the next few slides. While we will show data for every one of the major metropolitan areas, I plan to discuss three markets in detail: Charlotte, Los Angeles, and Miami. These three regions paint a nice contrast in terms of their risk-return profiles, and they're highlighted with yellow diamonds on each one of these slides for easy reference. In terms of the presentation flow, I plan to first review the results for these markets, and then in the following slides layer in the industry drivers to explain why a given market tends to outperform or lag national averages. In terms of how to read this slide, the left-hand chart presents the growth rates on a quarter-to-quarter basis, whereas the right-hand chart shows a year-over-year view. Over both timeframes, balance growth was positive across the majority of CBSAs, so that's a good finding in terms of loan growth. Starting from the top, we can see that Charlotte outpaced the national average for loan growth on both a quarter-over-quarter and a year-over-year basis. Balance growth for Los Angeles in the middle of the chart was flat for the quarter, but much more impressive when measured over the last 12 months. And then balance growth for Miami, which is directly beneath Los Angeles, that was slightly ahead of the national average on both a quarter-over-quarter and a year-over-year basis. On the next slide here, we examine spread pricing trends across these same regional markets. The chart on the left plots the weighted average LIBOR equivalent spreads in 2Q17 and 2Q18. Then the chart on the right plots the change in spread between these two quarters, allowing us to more easily see the magnitude of the change within each market. At the national level, spread pricing declined year over year in 2Q, and that trend was reflected across most of the local geographic markets pictured here. Third from the top, we can see that Charlotte was one of the few markets to report an increase in spread year over year. As of the second quarter of 2018, the average spread for Charlotte exceeded the national average. Los Angeles and Miami both reported decreases in spread pricing year over year, with an especially sharp decline seen for Miami. You can see on the right chart there that Miami was second only to Phoenix in the year-over-year change in spread pricing. Even after this decline, though, the average spread for Miami was far above that, or was far above most of the other geographic markets we saw here. I think the one exception was Dallas, that had a high spread due to its high concentration of oil and gas loans and real estate lending. A similar picture is shown here on slide 35. This time we'll replace the pricing metric with a weighted average risk rating. And this risk rating is based on the RMA 10-point scale. At the national level, credit quality deteriorated slightly from 2Q17 to 2Q18, as reflected in the increase in weighted average risk rating. You can see that at the top of the left-hand chart there. Near the top of this list, I believe it is third from the top, Charlotte. That's an interesting metro because its credit trend moved in opposite direction to the national average. The weighted average risk rating declined or improved for this particular market. So as mentioned previously, Charlotte was notable in that this region displayed an improvement in credit quality along with an increase in spread pricing. We don't see that for too many markets. At the middle of this list, we can see that Miami displayed the largest year-over-year improvement in credit quality seen across the selected metro, seen across the regions we're spotlighting here. So if you look on the right-hand chart, Miami had the biggest decline in weighted average risk ratings. That's a good thing. Directly above Miami in this list is Los Angeles. The weighted average risk rating for LA increased or deteriorated over the last year. So not only did Los Angeles report a decline in spread pricing, it also saw its credit quality profile erode somewhat. That combination of trends can mean that competitive forces are intensifying in the region. So while Los Angeles is increasing, it's seeing loan balances go up, the pricing's coming down, and the risk is increasing. That's usually a sign of competitive pressure. Now, one region that potentially showed signs of intensifying competition was Los Angeles. While loan balances continue to grow in this region, as I mentioned, the spread came down and the credit risk increased. Now, Pricing Dashboard users can see exactly what is driving this type of result, whether it be a particular industry, some particular loan type, a function of competition, or a combination of all those trends. For this particular example, I chose to drill into the 10 largest industry subsectors in the Los Angeles metro. That's what's plotted along the x-axis of this chart. And what we're showing here, we're going to start with balance growth. Year-over-year balance growth in Los Angeles outpaced the national average, as shown by the first pair of bars on the far left of this diagram. There are a number of industries in Los Angeles with impressive year-to-year loan growth rates, but one sector that caught our attention was credit intermediation, which is highlighted in the middle of the graph with that yellow diamond. Credit intermediation consistently ranks as one of the largest industries in Los Angeles, as well as for the country as a whole. Borrowers in this particular segment include mortgage companies and factoring companies. Banks with exposure to this segment may be indirectly exposed to fluctuations in the mortgage market and other areas outside of the traditional C&I lending space. So that means that balance growth and loan defaults for this particular subsector are very sensitive to fluctuations in the unemployment rate or U.S. mortgage rates, especially under an adverse economic scenario. Now, keeping our focus on the LA market, here we examine variation in pricing trends across the region's largest industry subsectors, the same list from the preceding slide. We had noted earlier that the spread pricing for Los Angeles declined year over year in June. That drop in pricing was reflected across many of the region's largest industry subsectors, including most notably credit intermediation. Since credit intermediation is growing in LA, its pricing trends weigh heavily on the region's overall results. Even after this drop, though, the average spread for credit intermediation is still relatively high in Los Angeles. It's also worth noting that LA's decline for credit intermediation in terms of pricing mirrored a similar trend at the national level. So if you look on the graphic on the right, under the yellow diamond, we also saw the spread for credit intermediation come down for the country as a whole. So it seems to be a more broad-based trend going on there for that subsector. Now, we had labeled Los Angeles as a watch list market because its year-over-year decline in spread pricing coincided with an increase in credit risk. The prototypical industry of this trend was, again, credit intermediation. In Los Angeles, the weighted average risk rating for this particular subsector, highlighted by the yellow diamond here, increased more than a full rating over the last year. So again, we're employing a 10-point risk rating scale, so a full rating increase is quite a change on a year-to-year basis. We did not observe this same trend for the country as a whole, where from that perspective, the weighted average risk rating for credit intermediation actually declined or improved over the last year. We now turn our attention to the Miami core-based statistical area, which is one of the largest metros in terms of both C&I lending and total real GDP. Miami is what we had called a neutral market since its decline in pricing was matched by an improvement in credit risk. Similar to the results for Los Angeles, the credit intermediation subsector was a key balance growth driver this last year in Miami. Earlier in the webcast, Don had noted the prevalence of real estate lending in several large states, such as Florida, and a similar profile was observed here for Miami, where second from the left, we can see that real estate balances were up significantly over the last year. For reference, real estate and CRE loans made up a larger share of total new renewed volume in Miami versus the national average. So the prevalence of CRE lending in Miami is one reason for why, as we saw earlier, this metro posted a higher average spread versus the national average. While pricing in Miami is higher than average, this same market posted one of the largest year-over-year declines in spread pricing that we saw across the main regions. From an industry perspective, Miami's year-over-year decline in spread pricing was driven heavily by the credit intermediation subsector. By comparing the Miami chart on the left with the national picture on the right, we can see that the decline in spread for credit intermediation was much more pronounced for Miami than experienced for the country as a whole. In several ways, the broad growth and pricing trends in Miami were similar to what we had observed in Los Angeles. Specifically in both regions, we saw balances rise and pricing fall over the last year for the credit intermediation subsector. However, there is one important difference between Los Angeles and Miami related to both credit intermediation and the overall regional averages. Whereas credit risk had increased for Los Angeles, credit risk declined for Miami. For the Miami chart on the left here, take a look at the credit intermediation subsector, which is the second of the yellow diamonds. For credit intermediation, the decline in spread pricing seen in the Miami CBSA was commensurate with an improvement in credit risk. The improvement was more than a full point on that RMA 10-point obligor risk rating scale. So that's a very significant improvement and one with the most favorable impact on Miami's overall risk-return profile. Now, rounding out our analysis here is a spotlight on the Charlotte market. I know we're coming up on the hour. Just a few things I want to point out in Charlotte. Charlotte was what we had called a high opportunity market due to its combination of good loan growth, increase in spread pricing, and decreasing credit risk. Year-over-year balance growth in Charlotte had outpaced national averages for several major industry subsectors. It was a pretty broad-based trend that we saw occurring across the Charlotte CBSA. In terms of spread pricing in Charlotte, there were two sectors here I want to highlight for you, both with the yellow diamonds. Spread pricing increased year over year in Charlotte. That trend was not as broad-based as contrasted with the loan growth trend. Instead, the reason we're seeing pricing tick up in Charlotte, it mainly relates to the construction subsectors, primarily that construction of buildings, which is the fourth industry shown on this particular graphic. And while construction tends to have a reputation of being a more high-risk sector, we actually saw the risk decrease year over year for the construction subsectors in Charlotte. So the overall improving risk-return profile for Charlotte, that in large part was driven by this particular metro's level of construction activity. Now, for your reference, we included a summary of the major risk and return trends that we discussed with some of the highlights for the three metros that we had spotlighted. More broadly, we hope that today's special topic served as a use case for how the pricing dashboard can be used to pinpoint high opportunity markets, as well as markets where competition is intensifying. That intel can help you make more informed decisions about lending strategies across your footprints. And as Don said, if you go to the next slide, please. We're always happy to have those discussions with you. So if you have any suggestions for what you might want to see next as a special topic in these webinars, or if you had any questions about some of the specific metros we highlighted, we encourage you to reach out to us.
All right, with that, that concludes our webinar today. We'll just take one moment to see if there's any questions since we are at the hour. Since we don't have any questions, or maybe people are typing them, if we're going to close the webinar, you can certainly email us with any other questions. And as a reminder, we will be sending out a link so that you can listen and download to this webinar tomorrow. Thank you and have a great day.